Good afternoon, everyone. I've got Mike McGlone, is the senior commodity strategist at Bloomberg Intelligence. I'm super excited about this one, Mike. How are you, man?
I'm good, Steve. Thanks for having me on. I'm looking forward to this.
I love it. Growing up, I always wanted to be a stockbroker, but the first thing I had to learn being from Illinois was futures and commodities. So I really like this, and I'm very super excited about this one. And what's interesting? We have a whole lot of new traders in the world right now, Mike. So tell us a little bit about yourself and how you got started, and where you're at now, what you're doing.
Well, I love that juxtaposition of you're mostly from New York area. I grew up in Chicago, and I grew up by the Chicago Board of Trade, so I kind of grew up more in a futures background versus I worked for the last 3 decades or so in the New York area from Connecticut, and I so enjoyed the New Yorkers who had more of a equity background. For me, it's just futures and commodities and corn and soybeans and T-bonds. And so I started in trading pits in Chicago in 1988, partly because I got out of college and my brother was working down there, and I didn't want to spend my rest of my life doing what I'm doing now, just sitting at a desk. Just wanted just to be and have some fun, and I did. It was great. But now here we are, moved from Chicago to New York in 93, moved to Miami in 2021, and I'm senior commodity strategist for Bloomberg Intelligence. And it's a fun gig, and and we're having a great environment for markets right now.
Yeah, and you look at this market today, and you got to go, wow! Look at all these new investors, new traders, and they're getting excited about futures as well. But when I started, it was the bean pit was right next to the bond pit. So you remember those days, right? Of course, that's gone now. But when I look at now, it's almost all electronic trading. So
Yeah.
you've seen it all yourself, like myself. Talk to us a little bit about the history of how you did it yourself at with the technology today.
Well, I really appreciate you starting there because it's part of the issue I have with things like cryptocurrencies. They're just numbers on a screen with no basis, except for the stable coins or crypto dollars. And I look over at futures. Now, there used to be in the trading pits, that's where they traded and they printed those numbers on the screen. And in the pitch, you had an edge. You could sometimes just feel where the mark was going to go by how much people were sweating. If they were stressed out, you can kind of sense where the stops were, and you could trade with an edge. But now everything's electronic. Everything's just a number on the screen. It's a question of what kind of basis you have underlying. And what's the edge now? You have to have some kind of algorithm or a good system, and then once they start working, they stop because that's how markets work. It's one thing I love about markets, though, is human natures will never change. And some of my best calls are sometimes just kind of sensing when everybody's too bearish or everybody's too bullish. And the key thing that's now that I think is helpful is I get a good sense of markets from social media. Before it was in the trading pits, being on the phone, talking to a dozen customers or more all day and speaking to people overall, and even being off the desk talking to people. Now you speak much less to people, but you speak to much more with IBs, with texts, and just watching social media. You get a sense for extremes. And that was one of the key things that tipped me off last year, that cryptos were just too silly, stupid, expensive. There was so much extreme bullishness, stuff I remember. But the key thing to remember, though, I enjoy is human nature, and markets will never change. And markets are about humans, and the theory of the crowd really works. It really worked great this month. I mean, just silver and gold got way too crowded, expensive. And now we've had epic collapses. And the biggest crowded, most expensive trade in the history of mankind is U.S. stock market. It keeps going up. Someday that's going to stop. I don't know when, but you tell me, Steve. Please help me out with that one.
Well, my crystal ball is broken, so I'm not really sure, but I do love the fact. It's interesting. When I was shorting silver, a week ago, I think people were just making like berating me on social media. No, we're going to 500 on silver.
Yeah.
What is it? What is it different about these traders today? And I don't want to say kids these days, but that's how I feel sometimes. Mark, what is different about today than say the 70s trade of silver or the 80s trades of the corn market when they went crazy? What is different about the trade of the psychology, or maybe the technology is maybe better? I don't know. Tell me what the difference is.
Well, I love what you just said because that's the benefit. What I do here is I don't trade anymore. I used to be addicted. We're not allowed to trade at Bloomberg. We have minimum 30 days. Everything has to be pre-cleared. I mean, I used to trade. I came to New York to be over-the-counter options trader in U.S. Treasuries in 1993. So trading can be addictive. And just what you said about silver nailed it. So I had to write. So I do it in words now. I deliberately was provocative and put silver around $100 is probably a prudent short. Now it did run up to 121, and a typical trader could be stopped out. But when you're trying to pick a peak in a market that's going up a lot, you don't sell a lot. You sell a little bit, or use some kind of option strategy, and you determine, okay, and then when it gets up stupid expensive, you sell more. But silver was a classic, and you have to be told how much of an idiot you are to know you're going to be right. It's the lessons I learned in trading pits. I remember my job was I was always on the phones. And my job was to cover markets and help customers mitigate risk and help speculators make money. And I'd come up with an idea or ideas every day. And sometimes when you had a great idea and you call up your 7 best customers and everybody agreed and did the trade with you, that was great. You got the commission, but you knew you were going to be wrong. Because when they all agreed, is when they all called you an idiot and you're going to be wrong, you were wrong, you were usually right. Just how it works. I love how it's just more extreme now. It's in your face with social media, and particularly I don't really watch too many of the responses that I get on X and LinkedIn anymore. LinkedIn
Hmm.
I do because they're much more civilized, but sometimes on X, you see someone who writes something really unnecessarily unpleasant, and then you see they have like 10 followers, and I understand why, but you know when you get that, you tweak something, and they don't realize how often they're really telling you their position. So if you like when I wrote about Bitcoin dropping potentially to 10,000 starting last year, first of all, they called me Mick Retard, and a few people were just extremely upset. So first of all, and then when they get that upset, number one, their position, they're uncomfortable with it, or else they wouldn't show emotions because good traders never show emotions. They might fake it, but you just have to stop yourself in, stop yourself out, use the discipline. Don't get emotional. And when you express those emotions, you've already won, they've already lost, and they just help give you good indications. So I'm sticking with that call. Now they're blaming me a little bit, which is a bit of the ultimate compliment because I'm just I'm a fish in the sea. But just it's a wonderful thing, and the key thing to remember for all traders is in commodities, it's almost always best to be contrarian because when everything gets too extreme, remember commodities are very autocorrelated. They go down because they went up, and vice versa. And when they go too far, you do the opposite. And when you sense extremes, you have to be careful and do the opposite. So right now, that was the extreme I sensed. You and I both got it in silver. I mean, we've been around long enough to know why it's called the devil's metal, and it proved it last week, and it's wonderful to have said it, and then it proved it for us. And it was just one of those lessons when people kept saying, I had a call this morning from an old New York investor who's very senior. She's been trading and investing in precious metals forever, and she gave me the lecture about, I called for silver to drop to 50, and I called for a peak in gold. I haven't done that for like ever. I've been bullish metals forever, and she lectured me in all the fundamentals. I'm like, yeah, they just shifted because of price.
Price dictates, right? I mean, that's part of it. I mean, you talk about
Yeah.
the devil's metal. Well, let's switch it over to just it's cold up north and UNG, the Widowmaker, right? I mean, it's the same
Yes.
situation. We've got a situation right now where people are going, oh, like UNG is going to go, natural gas is going to go all the way up. And it's like, well, when it warms up, there's still the same supply. What is it about commodities that make it a little bit different other than futures? What makes commodities different of the understanding from new traders or older traders? Say they're not stocks, it's commodities. It's what we eat and we
Yeah.
use. And what makes it different? And also, what makes it scary to a lot of new traders, commodities?
Well, the key thing about, I think, being young now, which is a wonderful thing. I consider the 60-year-old me very young if I get lucky enough to be 80 or more. And the thing that now is people always get jaded. Your average 30 or 40 something now has only seen one significant market since 2008, and that is it. Stock market only goes up. We've only had 2 down years. The entire system's there to support you. There's no more recessions, and you have to buy high, sell higher in stocks. So, okay, I get that. That's going to end, and when it does, it'll be dramatic. I think it'll be this year. The difference in commodities is anytime anybody gets bullish commodities, you have to be very careful because only you should only get bullish when they've been beat up and down for a long time. I'll give you examples. Cocoa in 2024, it's beat up and down and stuck in a narrow range forever. It finally broke up and went up like 10x. Platinum until June of last year is beat up and down forever. It can only go and went up. Once it goes up, you don't get long. And like you just mentioned, I just made a significant call on natural gases. Every time it goes up above 5, right now it's 3, the front contract, the U.S. brings on more supply. It's just waiting in the wings. And also it cuts off the demand a little bit. And the number one thing for natural gas is people talk electricity. I might give up electricity. It's 60 to 70% cold weather. And we're in a global warming trend. At least we were. Now we have 2 colder than normal winters in a row. And then when you talk with my son yesterday about the Hudson freezing over, that's a problem. But you look in this morning, and natural gas, the fund contract is down 27%. It's just, don't ever get long a commodity like that after it goes up. If you missed a trade, wait for the next one. And sometimes it's worthy to test shorts timidly. So that's why I look at, you talked about UNG, I just look at that front natural gas contract. Right now it's 315. The front contract was in its March. The February contract peaked around 7, and here we are half the price. But it's looking forward to what's going to happen. Are we going to have the Hudson freeze over? Will it freeze over next year? Or is the global warming trend to continue? And by the way, let's think about the more significant factor right now. We do have a motivated president for lower energy prices who has the ability to make that happen. He showed that with basically taking over Venezuela. And he has an election coming up. I look at that as just like natural crude oil just peaked and just popped around $65 a barrel, and everybody was so bullish last week. I just pointed out, look at last year's median mode was around 65. It's a bear market. There's an excess of supply. The whole world's shifting over to the Western Hemisphere, becoming the price maker. Every time you hear about supply disruptions in the Middle East, prices spike. People in the Western Hemisphere sell forward, and the prices go back down. So I will make a call. I think crude oil might have peaked for the year around 65. We need some kind of significant supply disruption for it to go higher, and it's probably going to go back down to 40. Why is that not profound? Because that's what it's done for the last 20 years, and the difference in the last 20 years is this year alone, the excess of crude oil, liquid fuel, and of supply over demand from the U.S. and Canada is approaching 8 million barrels a day. To put that in context, the last time crude oil got really cheap was in 2020. The excess was only 3 million barrels a day, and all of our history is we were in a deficit. You see the shift there. So you look for, it's a bear market. If it's cheap, you stay away. You wait for a chance to sell, or you try to buy cheap. And that just happened in Bitcoin. It was a bear market. It popped. Wait to try to sell. It just happened in copper. It pops. You wait to try to sell. Now, the difference is copper's a bull market, so you have to be different, a little more nimble about it. But that's the way I look at. The bottom line I look at market this year is I have a key theme. Sometimes I start with, and then see how it pans out. And to me, my key bottom line theme is U.S. stock market volatility will go up this year. NASDAQ 180-day volatility right now is the lowest since 2018. Now that's almost 8 years. It's got to stay low. It absolutely has to, for things like any type of chance for any risk assets to go up. You need the stock market to go up, for copper to go up, for Bitcoin, cryptos to go up. Basically, in that S&P 500 is pumping up around $7,000, or 7,000 on an index. And then you look at for divergences. So I look at it as a strategist and as an ex-trader, that the opportunities this year I think are going to come when that volatility we're seeing in cryptocurrencies and precious metals and commodities trickles over to the stock market. I didn't say if, I said when. The problem is it's been staying a lot lower volatility and much more resilient, a lot longer than I thought. But there's been great opportunities to do other things.
And Mike, as we're talking, we've got a question mark coming in now about the long bond. It says that you are bullish long bonds. Thinking about the long-term chart going back to the 80s, where yields were, just started to roll over, as he said. Could we easily get a little mean reversion back to the 6, 7, or 8% on the 10-year? That's interesting. Ooh.
So I appreciate that question. First of all, I want to full disclaimer. I've been wrong and being bullish bonds for 3 years. Now, I have to admit that I started in that it's US1 is the symbol, the T-bond future, and that trading pit in 1988. It's part of what got me promoted to New York from Chicago in 93. I called the bull market right. The difference now is, let's look at that Treasury bond future on a weekly basis. The 100-week Bollinger Band is the narrowest since 2008. Now, 2008, I was very bullish bonds and gold. I got lucky, but I got long and bullish in 2007, so I had to take the pain. The difference now is I look at the bond market, it's almost a complete basically a put on the S&P 500 with positive carry, basically getting almost 5% in TLT because it tracks a 20-year. Volatility is extremely low. It's ready to break out. And if you just said if the 10-year note yield were to pop that much, expect the whole market to collapse. I mean, that's major stock market, that is. That's a major competition for the risk-free asset. Just to go above right now, above it's 428. I look at that 30-year at 491. So I'm looking at the 30-year bumping up against 5%. And if you overlay that 30-year with like the January natural gas contract, they're both bumping above 5%. What's the motivation for the midterms? For Mr. Trump, he needs lower energy, lower yields. Okay, so I'm sticking with that. There's a good potential they might cut back on the bond auctions. But the bottom line is when people call for these pump in yields, have to fully expect what that means for, it's the riskless security. Now, going down the curve, obviously, going out, you have duration, but that means there's major competition. If we were to get that pop in yields, fully expect the stock market to drop a lot and have a problem. And it's also inflationary, and fully expect the Trump administration to be maybe have the words that we would be saying by this time next year to be Mr. Trump and lame duck, because he'll get crushed in the midterms because the key theme is inflation. Yields going up means inflation. That's not good. And I mean, mortgage rates going up, the housing market's already depressed. So that to me is a bit of a depression, that type of scenario. My thought is the more likely scenarios, we have a major trend towards historically towards post-inflation deflation in China, significant in that right now, even though they're massively pumping their system with fiscal monetary stimulus. Their 10-year note yield is 182. And as we speak in this country, they're 428. Now, I've been pointing this out for a while, but the bottom line is I think the long bond will kick in once the U.S. stock market reverts and drops a little bit. And I'll end with this. Right now, U.S. stock market's about 2.3 times GDP on an end of the year basis. That's the highest since 1928. So if we have a 10% drop, that's almost 25% of GDP. We're going to get that at some point. It's just the most in history. So it's also the stock market's like the most expensive versus a commodity market in about 25 years. So it's all tilting that way. And then I look for alternatives. So one key alternative was gold. Gold was one of my major calls for ever, but the key thing is you have to take the pain for the gain. So I was calling for gold to go above 2000 in 2021, 2022, and 2023. I was wrong. Finally breaks out in 2024, and now it's just too expensive by all my major measures. And I look at that trade's done. Silver trade is done. And to me, the next big trade is treasury bonds, and it's predicated on one simple little factor, a little bit of normalization in stock market volatility. And as we speak, S&P 500 is up almost 1%, and it just doesn't care so far.
Yeah, and you look at but the thought process behind the markets right now, it seems to be thrown out the window. I mean, you and I understand seasonals, you and I understand fundamentals, you and I understand technical analysis, but it seems like all that's been thrown out the window, right? It's just buy higher and sell higher and buy higher and sell higher. It's this FOMO trade going on right now.
Well, it's classic what happens in markets. We have a little bit of a shorter term case of what happened in cryptos last year. They peaked on a similar mode. Oh, everything was wonderful because of the Trump administration. And now Bloomberg Galaxy Crypto Index is down about 40% from last year's high. It was down 20% last year. Right now it's down about 20% this year. It's going to keep going. It's just a classic case of that's the way you put highs always on euphoria. And we certainly have significant euphoria in the stock market. It's just been lasting way longer than I thought. But that's when you have to just find alternatives and wait for the opportunity to really pounce. I think this is going to be a pouncing year. So for me, forever, I've been not so bullish on the stock market forever, and I found great alternatives in Bitcoin. I thought it was a tremendous risk asset, particularly in 2020 when it got around 10,000, and I just called for it to add a zero. And then it was gold to me the whole time, but both of those markets are done. I think they ran their course, and to me, that's where I'm looking for. We just have to see how the stock market pans out. But I look as a commodity strategist that we've seen potentially so far a peak this year at crude oil around 65, potentially a peak in copper around just above $6 a pound. Obviously, I think a decent peak in silver. These are all industrial commodities. And for those to go higher, number one prerequisite is the S&P 500 has to stay above 7,000. If it does a normal correction back down to 6,000, these markets are already telling you what they're going to do. I think they're already telling you they're going to deflate more. And that's where we stand. And as a commodity strategist, people say, well, why do you keep talking about the stock market? I'm like, well, it's what matters. If you have a position and you're sitting there at your desk and you're long copper, you better be so concerned. The number one thing, okay, you look at supply and demand fundamentals. Well, they're all backward looking. You try to watch what's happening in China. It's everyone's demand source. You try to happen what's happening with supply out of South America, but they're all lagging. The number one thing that's going to make you lose any money in a copper long right now is, let's say, which is put in our factor S&P 500 is up or down 10% in a week. Down 10% in S&P 500 means copper will probably be down 20%. It's the number one risk, partly because we're so extreme.
And when you talk about Dr. Copper in that aspect, I mean, I always look at it more of a question mark about watching TV and commercials. And when I see gold commercials and silver commercials, I'm like, whoa, wait a minute. There is a reason why they're doing that, because they want to sell their product. And in copper, I look at, okay, when is my house going to get hit by some thief trying to steal the copper out of my air conditioner, right? And that's when I look at so is there do you look at it from a perspective of like, that's just common sense of when to buy things and sell things, right?
Well, for us, it is, but it's the human nature of markets, and oftentimes it's being a tape reader. I'm watching all my screens and all the TV stations. When you see the consensus, it was classic last year, and it's so much easier now on social media. Like if you watch podcasts, I just look at the headlines sometimes, what they're talking about. When they're all bullish, you want to be careful, particularly when they're bullish and long and talking their book, it's the human nature that's wonderful part of bull markets. Like the call I had this morning from a prominent, someone who I knew forever investing in gold, who we've talked for years, to hear her kind of lecture me about how it's going higher and how silver's going higher when we were both bullish 10 years ago is kind of silly. I'm like, don't you think you should be taking some profits? But even the smartest people get fallen on that. I'm guilty sometimes too, but you have to try to keep the discipline. So that's what to me, the discipline this year was, okay, so far sticking with here's a key theme. I fully expect at some point stock market volatility is going to end the year higher than it is now. I mean, it ended last year like 180-day volatility. It ended at the lowest since 2018. So I think it's going to go up. So I'm looking for opportunities. What are the first opportunities? Well, Bitcoin near 100,000. So far that's held. It's going back down now. It's at 78. Copper above 6. So far that's held. Natural gas is different, but crude oil 65. So far that resistance is held. You look for the opportunities and make the market prove you wrong. So commodities are much more for trading. There's only one commodity that's really not a commodity that really should be able to hold long term over time, and that's gold.
It's gold. That's right. And of course, I love orange juice. I love frozen concentrated OJ futures. That probably is a widowmaker in a lot of ways, but being a Floridian in a lot of ways. All right, let's go to this point. Last question for you, Mike. Your career at Bloomberg. How did it happen? Talk to us a little bit about your career.
Well, I want to first. I'm glad you mentioned orange juice because I love oranges. My colleague Jonathan Levin, right next to me, and I were talking a lot about orange juice 2 years ago. Had a big up year in 24, and guess what were some of the worst commodity performers last year? Orange juice and cocoa. They were the best performers the year before. That's the way they always work. But I came to, and so it's the key thing I always remember is when commodities are autocorrelated, they go down because they went up, they go up because they went down, and it's just a matter of booking the timing in. And that's probably part of what got me to Bloomberg was, I think initially I was at S&P. I ran the commodity index business. I got to know a lot of people at Bloomberg and made the connection, and they liked my analysis and my write-ups, and so far so good. I've been enjoying it. The key thing at Bloomberg is like I mentioned, I can't trade, which is good. I can invest all I want, and I'm 60. I've done my fair share of trading, but I have the experience. And when you're an ex-trader and you're watching the market just right about, you really get a sense of, number one, what I probably would be doing, and number two, what I would be doing wrong, where would I got stopped out and might get back in, and it really helps to make the analysis, because you become so much easier to be callous and indiscriminate about a market when you're not involved. And once you get involved, it can distort the view. Now, it's typically means you're talking your book, which, lesson I learned on Wall Street, you don't expect someone else to talk your book. But the key thing here is I'm basically drinking water from a fire hose, and there's so much information. I'm guilty if I don't use it properly for good analysis. It really helps me, I think, hone my views, and we'll see how that works out by some of these views by the next time we speak.
I love it. And that's the next question I was asking you, Mike. We love having you over here. We love Bloomberg. And would you guys come back and continue this next week? We'll do it again.
I'm looking forward to it.
Thanks, Mike.
Thank you, Steve.